Have you ever thought, I don't have enough money to start investing? Many people feel trapped by their bills and expenses, believing investing requires large sums of cash. The truth is, even tiny amounts can grow into significant wealth if invested wisely and consistently. In this video, we'll explore practical strategies to start investing with a small amount of money today. You'll learn how to leverage fractional shares, micro-investing platforms, small contributions to real estate, crypto, and even digital tools that compound your wealth over time. These steps are designed to maximize growth without requiring huge upfront capital or risky shortcuts, turning pocket change into a powerful financial foundation. 1. Execute fractional real estate syndication. Real estate has traditionally been considered a high-barrier asset, often requiring tens of thousands of dollars for a down payment, plus additional costs for maintenance, taxes, and insurance. This has made it difficult for small investors or beginners to participate in the market. However, modern crowdfunding platforms like Fundrise arrived and Lofty have revolutionized access, allowing individuals to buy fractional shares of commercial properties, rental homes, or logistics hubs with as little as $10 to $100. This means you can gain exposure to high-quality, income-producing real estate without needing to manage tenants, collect rent, or deal with mortgages yourself. By purchasing a small slice of a larger property, you essentially become a shareholder in institutional-grade assets, enjoying proportional returns on rental income and property appreciation. Fractional real estate investing democratizes access, allowing small investors to benefit from opportunities previously reserved for high-net-worth individuals. Over time, even modest contributions can accumulate significant value through reinvestment of distributions and long-term appreciation. For example, investing $50 per month into a fractional commercial property can gradually grow into substantial equity as rental income compounds and property values increase. This approach also reduces risk through diversification. Rather than buying a single property and being exposed to all associated risks, you can invest across multiple properties, locations, and types, spreading exposure while participating in the market's overall growth. Moreover, fractional real estate platforms often provide detailed analytics, historical performance data, and automated management features, making it easier for investors to track returns, assess risk, and make informed decisions. Some platforms allow reinvestment of dividends automatically, accelerating the compounding effect and building wealth more efficiently than traditional bank savings. For small investors with limited capital, this method transforms real estate from a distant goal into an accessible, practical wealth-building strategy. It demonstrates how small, consistent contributions, combined with smart platforms, can unlock the long-term power of real estate investing and create cash flow that fuels additional opportunities, accelerating the path to financial freedom. 2. Automate micro-yield aggregation. Micro-investing platforms allow you to turn everyday purchases into investments without even noticing the impact on your daily budget. Apps like Acorn, Stash, or similar tools automatically round up every purchase to the nearest dollar and invest the spare change into diversified index funds, or ETFs. For example, a $4.30 coffee is rounded up to $5, and the extra 70 cents is directed straight into the market. While this seems like a small amount, consistently applied over time create a powerful habit of investing, gradually building wealth without requiring conscious effort or large lump sum contributions. The beauty of micro-investing lies in its ability to leverage consistency rather than sheer size. Over months and years, these small incremental contributions compound through both market growth and reinvested dividends. For instance, rounding up daily purchases like groceries, rideshares, or online shopping can easily add hundreds of dollars into your portfolio each year, all without feeling like a sacrifice. Even beginners with limited capital can participate in long-term wealth creation, learning investment discipline, and understanding market principles. Micro-investing demonstrates that building wealth is not about waiting until you have thousands of dollars to start. It's about taking small, consistent steps that compound over time into substantial financial growth. 3. Build a custom fractional share portfolio. Premium stocks like Amazon, Google, or Berkshire Hathaway often cost hundreds or thousands per share. Fractional investing platforms, however, allow you to purchase small portions of these shares for as little as $5 to $10. By assembling a portfolio of fractional shares across multiple top-performing companies, you can diversify and access elite stocks without a large initial capital outlay. This approach allows small investors to participate in high-growth opportunities and build wealth proportional to performance of top-tier companies over the long term. Fractional investing also reduces entry barriers, making it easier to start immediately and develop a disciplined investment habit. 4. Create an asymmetric crypto microtranche. While traditional stocks compound steadily, small allocations to high-volatility crypto assets can provide asymmetric upside. Allocating a tiny, disposable percentage of your investment, such as $5 per week, to blue-chip cryptocurrencies like Bitcoin or Ethereum exposes your portfolio to potential explosive growth without significant risk to your daily finances. Because the amount are small, the worst-case scenario is minimal, while the potential upside is substantial. Consistency is key. Automated weekly purchases smooth volatility and allow investors to capture long-term market trends. Over time, these small crypto tranches can become significant portfolio contributors, complementing more stable investments. 5. Invest in digital sweat equity tools. The highest return on a small amount of money often comes from leveraging your own productivity. Low-cost digital assets like premium domain names, automation software subscriptions, or technical code libraries can be used to create scalable digital products. For instance, purchasing a $50 automation tool may allow you to build a niche app, newsletter, or online service that generates recurring income. These digital sweat equity investments turn small upfront costs into valuable revenue streams, increasing available capital for further investments. By combining skill with minimal capital, you create a compounding loop where your time and resources generate real, long-term wealth. 6. Utilize Roth IRA for tax-free growth. Even small contributions to a Roth IRA can have an outsized impact due to tax-free compounding. Contributions grow tax-free, and withdrawals in retirement are not taxed. By starting early, even with modest weekly or monthly contributions, you leverage decades of compounding, dramatically increasing long-term portfolio value. Combining small, consistent Roth IRA contributions with fractional investing allows you to access high-quality stocks, ETFs, or mutual funds without worrying about upfront wealth requirements. Additionally, automated contributions ensure that investing is consistent and prioritized before discretionary spending. 7. Use micro-investing for diversified ETFs. For small investors, exchange-traded funds, ETFs, are ideal because they provide instant diversification across hundreds of companies. Platforms like Webull, Robinhood, or Fidelity allow fractional ETF purchases for as little as $1. Small, recurring investments into diversified ETFs reduce risk while exposing your capital to broad market growth. Over time, even tiny amounts accumulate substantial returns, demonstrating that scale is less important than consistency and compounding. By starting small and automating ETF purchases, you gradually build a robust, low-cost portfolio with minimal risk. 8. Leverage cashback and roundup programs. Extra capital for investing can be generated through everyday spending by leveraging cashback apps like Upside, Rakuten, or Honey, as well as credit card reward programs. These tools provide small but consistent returns on purchases you would make anyway, creating a hidden source of investment capital. By linking cashback or rewards directly to micro-investing accounts, you can automatically funnel these bonuses, rebates, or roundups into your portfolio. For example, if you spend $200 on groceries and earn 2% cash back, that $4 can be automatically invested into an ETF or a fractional share of a high-performing stock. While the amount seems minor, over months and years, these incremental contributions compound, especially when combined with dividends and market growth, creating a meaningful balance without affecting your regular budget. This approach encourages disciplined financial behavior while turning routine spending into a wealth-building tool. It also leverages the psychology of passive investing. By making contributions automatic, you remove the need for conscious effort or decision-making, reducing the likelihood of procrastination. Additionally, combining cashback investing with other micro-investing strategies, such as rounding up purchases or automating small recurring contributions, amplifies the effect. Over time, A few dollars saved here and there can snowball into significant portfolio growth, illustrating the power of compounding interest and consistent investing behavior. Furthermore, using rewards for investment teaches long-term thinking. Instead of spending every dollar immediately on consumption, you begin to prioritize future financial security, even in small ways. Ultimately, cashback and rewards-based investing demonstrates that building meaningful wealth does not require large sums of upfront capital. It is consistency, discipline, and leveraging everyday opportunities that generate substantial long-term results. So, there you have it. 10 actionable strategies to start investing with a small amount of money that can grow into substantial wealth over time. From fractional real estate and micro-investing platforms to automated Roth IRA contributions, digital sweat equity, and disciplined habit formation, these steps prove you don't need a large sum to start building your financial future. If you found this video helpful, don't forget to like, share, and subscribe for more actionable financial insights. Thanks for watching, and we'll see you in the next video.